Hello everyone and welcome to today's webinar, Gold, Don't Discount This Precious Metal Yet. Please ensure you're connected to the audio and use headphones if possible for better listening. Today, Mr. Chirag Mehta, Senior Fund Manager, Alternative Investments, and myself, Ghazal Jain, will be sharing our views on gold as an asset class. Thank you, Chirag, for being here with us. We'll be addressing various questions like, has gold lost its shine? What are the reasons for the dip in gold prices? What does 2021 hold for gold? And what should you as an investor do right now? We have a dedicated time post the presentation for taking live questions. So we encourage you to send across your questions on the chat. Now, without further ado, let's get started with the presentation. I'll start with a quick recap on the price action in the gold markets. As we all know, gold had one of its best runs ever in 2020. International prices moved from below $1,500 to around $2,100 in a matter of a few months, moving about 40%. Now, this was, of course, because of the heightened risk and uncertainty brought about by COVID-19, as well as concerns about inflation and currency debasement, thanks to the never seen before monetary and fiscal pandemic relief that was announced by central banks and governments world over to cushion global economy from the impact of the pandemic. But breakthroughs in vaccine development since November, along with optimism of economic recovery, sent gold prices lower. Right, markets were focused on economic recovery, and investors chose to park their assets, their money in risk assets instead of gold. Now, since the start of 2021, gold has been under further pressure, as we've seen the US dollar and US yields have been strengthening. That's because markets are expecting US economic recovery to be more robust and faster, than expected. And markets think this will trigger inflation, especially since the Central Bank of the United States, the Federal Reserve, is insisting on keeping rates near zero till 2023. Gold's fall in the first 3 months of 2021 has been, even more surprising, given that fresh COVID-19 stimulus package was announced in the United States to the tune of $1.9 trillion, right? And this should have actually ideally resulted in dollar debasement, right, and strengthened gold. But the opposite seems to have happened so far. Nevertheless, prices are supported. They have corrected, but not declined very substantially, of course, because Federal Reserve and central banks around the world have ensured markets that there won't be a change in the accommodative monetary policy stance anytime soon. They're focused on growth, and hence we're not going to see a lot of change in, in the ultra easy monetary policies that we're seeing world over, right? So, with that, with that background, now risk assets like equities and cryptocurrencies have been rallying again on expectations of economic recovery, and gold has fallen out of favor. Investors are starting to question gold's role in their investment portfolios. But even though gold may have disappointed us over the last few months, we are going to give you 5 reasons why you shouldn't discount this asset class yet. I'll start with the first one, which is risk and uncertainty. Now, with many countries, including India, seeing a resurgence in COVID-19 cases, risk and uncertainty on the pandemic front is back. As you can see in this graph, new confirmed cases in major countries, continue to be elevated. New waves and variants of the virus are taking a toll on the nascent economic recovery that we've seen over the last few months. So this could trigger pullbacks in risk assets like equities going forward, and gold could then benefit from the resulting risk aversion, just like it did last year. Now, some of you would say that vaccines are here, and I agree. Vaccine rollouts will definitely cushion COVID-19's impact this time, but we have to agree that there's a long way to go till majority of the population gets vaccinated. If you take India's case, as of last week, only about 1% of the population has been fully vaccinated against COVID-19. Fully vaccinated means given both doses. In addition, safety and efficacy of these vaccines are still concerns. So, in summary, COVID 19 is far from over, and we're still tackling a health and economic crisis. And as we all know, gold, which provides stability and safety, plays a risk-reducing, return-enhancing role during times of crisis. Moving on to the next slide. Starting April, we have seen yields and the dollar retreat from their multi-month highs of March. Maybe markets are toning down their expectations of economic recovery and expecting central banks to intervene further. It seems like the dollar is finally reflecting the massive stimulus measures and moving back to its depreciating trend. So we're thus now starting to see gold prices pick up. In fact, even today they have moved up pretty much. So the question now is, has gold finally bottomed? And Chirag will explore and help us explore further on this. So taking us through the other 4 reasons onto why you should hold on to gold. Over to you, Chirag.
Thank you, Ghazal, and thank you, everyone. I hope everyone is safe and well, given these uncertain times that we are witnessing. So, coming on to gold, I mean, there are investors who kind of were disappointed with gold not doing so well, despite fundamentally nothing being wrong, right? So the charts that Ghazal showcased in terms of the stock markets moving up or Bitcoin prices moving up, are they moving on fundamentals? Currently, there was a kind of some disjoint. People or investors, given the liquidity sloshing around in the global economy, were chasing risk assets because they know that central banks are there and they will come and intervene if something goes wrong. So what everyone is doing is going in search for yields. Wherever they're getting higher returns or the prospect of higher returns, they are moving into that asset classes. And that asset classes for the last few months were equities and things like Bitcoin, risk assets as we call it, right? And therefore, if you're moving more money towards risk assets, risk averse assets like gold will suddenly be dumped because you need to pull out money from that and move into risk assets. So that was a trade going on for last few months. And that is where certain investors who jumped in the uncertain times of last year were kind of a bit disappointed given that gold did not keep rising. So no asset can keep rising in a straight line. There will be periods of correction, consolidation, and this was one with gold that we witnessed. But how about the prospects going forward? What are we seeing in the gold markets, right? Last few days, we have seen that what was pressuring gold was the rising US yield on a 10-year bond in the US, which was rising from say 0.6% in the lows during COVID and has risen to around 1.7%, 1.8%, right? Now it's coming back down again. The yields have been falling, right? So that has helped gold recover a bit. Dollar, which was strengthening, despite the amount, trillions of amounts being pushed in by central banks and the government in the US, it was rising up because people thought that, economic recovery in the US will be faster and therefore US will come out of the crisis much better than other economies, which is not really the case, right? The amount of money that be sloshing around really tells you that economy is in a bad shape and needs a lot of support. So let's look at where yields are and where it's likely to move, right? One thing for sure, that the economic recovery that we are seeing is still very, very nascent, still very, very fragile, right? So far, it looked like a V-shaped recovery, right? From here on, it's going to be a very, very gradual recovery. Why do we say that? Because if you look at the jobs data, right? Uh, uh, the jobs currently, the amount of unemployment there in the US is similar to what even now, despite recovering, is still closer to levels that we saw during the 2000 global financial crisis, right? Despite the recovery that we have seen. 2008 crisis took 6 years to bring all the jobs back, right? To bring down the unemployment rate to very, very low levels. So even from now, it will take a long time for the jobs to come back, right? And is given that there will be gradual recovery, it will need to be supported by governments and central banks. So any further increase in interest rates, any further increase in bond yields will lead to, will impact the economy and further take that much more time, or risk of slipping the economy back into recession are very high. So what will governments and central banks will do is try to cap the rising yields. They will not allow yields to rise significantly from these levels, because it will put a burden on the economy as well as put a burden on the governments, because interest will have to paid by these governments. If you look at the debt levels, they are so high. Any further increase in interest rates will cause a burden on these governments. So there are talks of yield curve control, and this could be the next bazooka from the central bank. So far, we have seen cutting rates to zero, negative rates. We have seen a lot of money being pumped in name of QE, which is nothing but money printing. They have been buying all sorts of assets. Some central banks buying equities even. So the next thing that they could look at is a yield curve control, not allow yields to rise beyond a particular level by buying as many bonds as they will have to, like we all know, do whatever it takes attitude of these central banks. That is what exactly the next step will be, something like a yield curve control. Right? So yields are unlikely to go beyond these levels substantially higher, from like the move that we have seen from 0.6% to 1.7, 1.8%. Such kind of move is unlikely to happen. Even if that move happens, that will be on the back of rising inflation, right? Inflation has to rise substantially. So what we will have as a result, or if you look at the equation, real interest rates, which is nothing but interest rates minus inflation, that's not going to rise substantially. If you see from Jan to March, yields have gone up from 0.93 to 1.74, a substantial 81 basis points increase in just 3 months. Whereas if you see the real yield has only gone up by 45 basis points, right? So real yields will be capped because inflation is on the rise, right? So real interest rates is one of the biggest drivers for gold. Gold will do well when real interest rates are falling or negative, and we expect that to happen going forward. And that is why gold should do well. This is what I was talking about. If you look at the red line, right, it is the real interest rates. That is interest rates minus inflation. Look at the 1970s. Look at the 2008 global financial crisis. Both the times we had negative real interest rates. And so we have it today, right? If yields fall further, inflation rise further from here, it will further go negative. And that's going to be a big impetus for gold. Gold should do well if real interest rates, which in all likelihood looks like happening, that real interest rates should fall from here on. That will support gold, and gold should do well because of this. So that's about yields, right? That's about what will likely happen or shape gold prices over the short to medium term. Long-term thing, if you see, we have very high levels of debt and very high levels of deficits, especially if you look at COVID crisis. That has led to a lot of money being tossed around by governments to support the economy, and that has led to fiscal deficit. This fiscal deficit is funded by issuing more debt, and therefore the more you run a fiscal deficit, given that you don't have revenues, you have to issue more debt. And when you issue more debt, who buys that debt? Either there are market participants who buy that, or now you have captive central banks. Central banks will buy a lot of debt from these governments because they can just print money and buy all the debt that the government issues. So if you, we'll come to subsequent slides in terms of how much debt these central banks are buying, but that is the modus operandi that we are seeing currently. So we have rising fiscal stimulus across the board, leading to higher deficits and leading to higher debts, right? So if you look at the debt levels currently of the developed economies, they are at levels we have not seen across few decades, right? Last time we saw such high levels of debt to GDP ratios was during World War II, when every economy or every country was printing a lot of money because, and GDP is going down, leading to higher debt to GDP ratios because they wanted to create arms, ammunitions, and putting a lot of money to do that. that was when we saw. Today, governments are putting in a lot of money because they want the economy to come out of recession. This is what we have seen across all recessionary times, and this time is no different. But if you look at the debt levels, they're very where it stands today, it's significantly higher, and we have seen higher debt levels continue to impact growth. So it's kind of a vicious cycle, right? You have higher debts impacting growth, and for growth, they will incur more deficits and more debt, right? So it's kind of a vicious cycle unless and until you get a meaningful, sustainable growth in economies. So look at the chart on the left hand side where each and every economy is printing a lot of money, right? These are central banks printing of money that they have done, each doing trillions of dollars or doling out trillions of dollars. And what these central banks are essentially doing is buying government debt. So for example, if you look at the chart on the right hand side, the percentage of GDP of these four central banks total is about 55% of GDP is the central bank's balance sheet size. The size has grown significantly over last few years, especially after the global financial crisis and more so after the COVID crisis, right? If you see, there is a vertical increase in most of the lines on the left-hand side chart, telling you that these economies or these central banks have printed a lot of money to push in the economy to try and make them stand in the shock that they have witnessed because of COVID, right? If you look at the blue line, which is the Fed balance sheet, their balance sheet has grown from about close to $1 trillion to about $8 trillion in last at least 12, 15 years, right? So that is very supportive of gold. So that vicious cycle that we are seeing, economies doling out a lot of money in the economy, running deficits. And if you look at the projections of the US running deficits, they will continue to run at least $1 trillion in deficits for next few years, right? Until 2030, they will at least have $1 trillion of deficits, right? Not in incorporating any of the shocks that we may witness going forward. Despite being a normal year, they will still continue $1 trillion of deficit. That's a projection made by the US CBO itself, right? So we will see a lot of doling out of cash by these governments. Central banks will continue to print money, and therefore gold should do well. Why gold should do well? Because at the end of the day, it is a monetary asset. So if you look at from 1974, line of US money supply and gold prices, right? If you look at how both have moved over years, today, if you look at where it stands, right? Gold is just a bit undervalued as compared to the money supply. And if you think in the future, you will see a lot of money being printed by these central banks because governments will continue to run deficits and therefore they will have to fund it and therefore they will increase the money supply. It doesn't incorporate that future increase in money supply. So at today, at best, you could say that this is fairly priced or just underpriced. And if you look at the future of what it is likely to unfold, gold prices should do well going forward. So this is just a US, how they have been running deficits and how their debt has been increasing, right? So if you look at the steep downward line in 2020, that tells you the kind of deficit that they ran last year, right? And therefore the debt has been increasing substantially. Another reason that would support gold is inflation, right? We all have seen the commodity prices increase substantially, be it price of oil, be it price of metals, be it price of food grains, all have increased substantially over last 1 year, right? Many people thought that given that central banks were printing a lot of money, even in 2008, it will lead to a lot of inflation at that time, but it didn't happen, right? But this time is different, right? This time we don't not only have central banks printing money, we also have governments putting in a lot of money, right, in the system. They have been giving dole outs like paychecks in the US. They are supporting businesses. They are doing further spending like infrastructure spending. So there is a lot of money being pushed by the government, right, which we call as fiscal injections, which was not there at that time during the 2008 crisis. 2008 crisis was largely a crisis of the banking system, right? It was not an economic hit crisis like we have in this time. And therefore, it was more central bank working and not the government working so much. This time you have the central bank working as well as the government working. So if you look at the blue line on the left-hand side chart, right? So you had elevated red line, which is nothing but the central banks working, that total assets of central banks, which had elevated. Money supply had not elevated so much. So central banks were printing a lot of, central banks were uh, buying a lot of debt, right? And if you look at government transfers, the doleouts by governments overall to support people, support businesses, was very, very low at that time. So if you look at the green line, was very, very low. But if you see as compared to the 2020 COVID crisis, you have the blue line rising because the government is doing a lot of handouts, the green line, and even the red line where the central bank is buying a lot of assets. Both are working together to lead the money supply increasing higher. The blue line, if you see, was not high as much in 2008 crisis, but if you see here in 2020, the blue line has gone up significantly, right? So that tells you that there could be inflationary prospects, which unlike 2008 did not materialize. So this could lead to further commodity price inflation going forward, and therefore there are inflationary prospects, and therefore the real interest rates that we talk about, which is a driver of gold, which is interest rates minus inflation. Given inflation will be rising, real interest rates would go down further. So this really tells you that this is another factor to watch out for, which will help gold. And lastly, the INR, the view on INR, right? INR also is a part of gold price. If INR depreciates, we could see gold prices move up. If INR appreciates, gold prices go down. That is what is happening, right? Apart from the gold prices in international markets going down, we also had rupee appreciating so far, which led to a further fall in gold prices in India, right? But if you see in a very short span of time, in like 2 to 3 weeks, we have seen a sharp depreciation in the rupee as RBI announced its own form of quantitative easing. So rupee could, if India is under shock and we see FII flows moving out, rupee could again back to the levels that we had seen earlier, right? Rupee could depreciate further. And if that happens, it will add to the gold price return in rupee terms. So what are we staring at right now when we look at the gold market? What could go wrong? Right now we saw the factors which will help gold, but what could go wrong? One is accelerated vaccine rollouts. If that happens, the shock to the economy will be a little lower, and therefore economy will mend a lot faster, which means the government may have to do lesser than what would be anticipated otherwise, right? What form of economic recovery do we see? Our sense is the economic recovery from here on, at least on the global level in the developed markets, will be far more gradual than what we have seen so far. So far, initially, we had anticipated it will be a V-shaped, but from now here on, it's going to be a very slow, gradual recovery. Rising bond yields could be another factor, like we saw last few months, that the increase in bond yields led to a fall in gold prices. If that happens, that could be a factor that will impact gold. And strengthening dollar could be another factor that can impact gold, because gold and dollar moves inversely, right? But on the last two factors, we don't see substantial increase in bond yields, and more so on the real bond yields. We think that if bond yields were to rise, increase further from here, it's going to be on back of inflation. So real interest rates may not increase substantially from here. So that's a lesser of a risk. And dollar, we think that it's at the forefront of all the deficits and debt creation that we have seen, and therefore there will be pressure on the dollar. What will help gold? If the pandemic keeps lingering, if there are issues surrounding economic recovery because of the pandemic, that could lead to a further increase in gold price. You will see gold price being chased after by investors. Second is accommodative and fiscal monetary policies, if they continue, which will likely continue because economy, despite pandemic happening or not happening or continuing or not continuing, uh, will need support for it to recover and mend going forward. Inflation prospects are very real. That could also help gold. And we have rising deficits and debt, which will impact growth, and therefore it will impact what governments are doing in terms of actions. So it will is another factor which will help gold. So overall, if you look at both all the factors here, the headwinds are not so material, not so significant. But if it happens, it will lead to fall in gold prices. But tailwinds or things that help gold are looking very, very positive, and could drive gold prices higher from here. So overall, what we suggest, what investors should do, uh, I mean, it may be that you bought gold at a very high level, higher prices when they were last year between 55, 57,000 rupees. Right now, they are lower at around 47, 48,000 rupees. So it has fallen about, say, 20% from the highs. But I think the fundamentals look really positive. So if you don't have the adequate allocation of 10 to 15%, these are good levels to add to your portfolio, right? It's not that, uh, if you are under allocated, please do add at these levels. Use the dip and consolidation that we have got to add gold to your portfolio. And if you already have that allocation, then I think you should stay with that allocation. It will, you never know, like COVID was an unexpected crisis, right? And the way it impacted the portfolio was very significant. And at that time, we all know that gold did really well, right? So you don't know the shocks that your portfolio will witness or the economy will witness, and therefore have an allocation to gold. That is what we suggest. So stay. The prospects for gold look much better. So stay invested. If you're not, add to your portfolio. Uh, so over with that view, please take it forward.
Thank you, Chirag, for taking us through the presentation. Before jumping into the Q&A session, I quickly want to introduce the SMILE facility to all of you, an initiative between Quantum Mutual Fund and Help Your NGO. This facility enables an investor, on the basis of his or her consent, to contribute some percentage of their investment with Quantum Mutual Fund towards a charitable cause to any NGO registered with Help Your NGO. To know more about this, please visit our website and check out our FAQs on SMILE or reach out to customer care. Now moving on to the Q&A session. Chirag, the first question. Quantum predicted gold to go to 75K in May, June 2020. What was the basis behind that assumption and what has changed now?
Yeah, so I think the kind of scenario that we were staring at last year has improved materially in terms of the economic recovery. Economic recovery has been very, very surprising, which we didn't anticipate at that time. And we expected a lot more action from central banks and governments to continue. But kind of the subsiding of the COVID factor that we saw last year and the resulting sharp bounce back in economy that didn't lead to that higher levels. And those were only suggested, it was not a prediction per se, but it was something that could materialize at a particular gold price level and at a particular rupee level. So it was not a prediction, but it seemed like factors were in place to gold prices to kind of move higher, and so they are even currently. So it was not a prediction, but I think what we always suggest, along with any price points that we showcase in terms of what could possibly happen because of the factors been aligning, is that gold helps, an allocation of 10 to 15% of your portfolio helps. And that is what gold has exactly done, right? It has fulfilled its role to what is expected. At times when your other risk assets or your other portions of portfolio were not doing well, gold did well. And when gold did not do well, the other 85% of your portfolio was doing well, right? So that is what you have to look at it, at gold in such a manner that always have an allocation. It will help you. Rather, what we say is have an allocation to gold and pray hard it falls by 50% the very next day, right? If it falls, meaning your 15% allocation is not doing well, your 85% allocation will do significantly better, right? And this is how what has happened, right? Gold did not fall by 50%, it fell by 20%, but your other 85% did significantly better. And now when your other assets are coming under pressure, like we have seen some sideways movement in equities, gold has started doing well, right? So it fulfills that role from a portfolio perspective, but we don't know about the levels where it will reach. But even today, the fundamentals of strong are very, very strong. That will lead to higher gold prices.
Thanks, Chirag. So where do you forecast gold prices to move over the next 6 months?
I mean, it is very difficult to pinpoint a level where it will go, but it should ideally, the factors that are shaping up should lead to a higher gold prices, right? I mean, 6 months is a very short time frame, but even then, the prospects look much better. I think much of the bad news is already in the price. What's not factoring is any further action from governments and central banks. Like the chart we saw, it's kind of fairly priced at this point in time. And usually the money supply line doesn't go down, right? It usually keeps inching higher over years. So it doesn't, if you look at the chart, it's fairly priced today or slightly undervalued, but it is not pricing in any further stimulus by governments, any further printing of money by central banks. So it's not pricing all that. If you think that's going to happen, then gold prices should ideally rise.
Thanks, Chirag. Uh, if and when cryptocurrency is regularized by RBI, what kind of impact will that have on gold as an asset class?
So I don't think it will have any material impact. I mean, maybe the speculative or the millennial generation may go towards such kind of fancy instruments. But overall, if you look at cryptocurrencies, right? Cryptocurrencies, there are more than 500 cryptocurrencies out there. What is the intrinsic value in that cryptocurrencies? Does anyone know? There is no cryptocurrency. What kind of, if you look at the volatility, it is unmatched to any form of currency, right? You may have a Zimbabwean dollar, which will have such kind of volatility that we have seen in the past. Look at the way it fluctuates on a daily basis, 4, 5, 10% on a daily basis of the movements that we see. It is far from being any form of characteristics of true money. Whereas gold, if you see, has been a form of money, has an intrinsic factor, has the trust and faith of millions of people. It is used as an asset by central banks. So it has all the characteristics of being true money. Whereas if you see Bitcoin is more like a fad. So I don't think it will have a major role in a country like India. I don't think it will find an acceptance in a country like India. You might get the millennial generation being attracted to such things, but I don't think many mature investors will move into things like Bitcoin. So I think it will not undermine gold's role, at least in countries like India, where gold is the sought-to asset. Today, if you see, the early movers are at an advantage, right? What about the other people who have not participated in at all in Bitcoin, and it's already at $60,000, right? So I don't think that it will pose any longer-term challenge to gold.
Sure. Chirag, what is a good lock-in period for gold? How much time should an investor keep gold in their portfolio for?
I think, see, if you look at a portfolio, each instrument or each asset has a role to play in your portfolio, right? So it's not that you just buy a asset for a particular time frame. You buy an asset for a fairly longer time, right? Because it will fulfill its role while you have other assets in the portfolio. Like gold is a good portfolio diversifier, a store of value, and that is why you own gold in a portfolio, right? You have debt, which is more a stability in the portfolio. You have equity, which will lead to wealth creation in your portfolio. So you don't abandon any particular asset classes, and there is no time frame. You may tweak the percentages for any asset class depending on how you want to go towards your wealth creation journey. But you need to have a gold in your portfolio because the kind of diversification benefits it gives your portfolio, there is no matched asset today that you have as an Indian investor. Gold is that asset that fulfills that role, and therefore you need to have, you could tweak your allocation, you could tweak it to 5%, you could tweak it to 10%. You could, I know investors who also have 20-25% in the portfolio. That is how they want to shape their portfolio. So every asset plays a role. You need to have all assets in your portfolio. The percentages can be higher or lower.
Sure. Chirag, what is the expected rate of return from gold over 10 years?
It is very difficult, but it will give you over a long term, it will give you at least inflation matching returns, right? If you look at it's a store of value. It's called a store of value because it surpasses inflation, gives you returns in line with inflation or better than inflation. So and that we are talking about real inflation, like what we all feel and pinch, right? Uh, if you have gold, that is the kind of return that you should expect. Uh, in, uh, so it is very difficult to say a level, but if inflation, say, over long time periods has been, say, around 9-10%, it has given that kind of return over the long term. So you should expect inflation beating returns or inflation matching returns at least from gold.
Thanks. Which is better to buy at this stage, gold or silver?
I think gold is a better from a portfolio perspective because silver, about 70% of the usage of silver is for industrial purposes, right? And when will industry do well? When the economy is doing well, right? So you kind of land up, your equity portfolio will also give you a similar kind of exposure, right? If economy is doing well, your equity portfolio will do well, industry will do well, and therefore silver will do well, right? So it kind of doesn't diversify your portfolio. You buy gold because it helps you diversify the portfolio. If the economy is not doing well, it's likely that equity markets will not be doing well, and therefore we have seen at those times gold does well. So as compared to gold and silver, I will always choose gold as a part of your portfolio. What we call is something as speculative play in your portfolio, which could be like 5% of your portfolio. You could have silver as that portion, right? Because silver, you need to understand demand, supply, what kind of uses it has, or how the supply is shaping up, and those things will determine if you should allocate to gold, silver or not. Whereas gold is any time an all-season asset to hold in your portfolio because it will help you in times of unexpected surprises to your portfolio, like we saw during COVID, right? During COVID, silver also fell significantly when other risk assets fell, whereas gold held it very well during those times. So if you were to ask me gold or silver, I'll always suggest gold.
Sure. The next question is on the best way to achieve gold allocation. Is it physical gold, ETF, or sovereign gold bonds? What would you suggest?
So I think one thing is very, very clear, right? When it comes to physical gold, you you have to you should not have physically with you because there are a lot of disadvantages to it. First and foremost, it's not price efficient. Be it any form of physical gold you buy. You buy coins, you buy bars, you buy jewelry. Especially jewelry is the most inefficient form of buying gold, right? Because there are premiums, there are making charges, there are a lot of issues like purity, etc., etc. With physical gold, especially jewelry. So I don't think the investors, as you count it as a part of your portfolio, should venture out on the physical side, right? Earlier, we all used to buy physical gold because there were no efficient alternatives available. Now, financial industry has given you a lot of efficient instruments like gold ETFs, gold saving funds, sovereign gold bonds. So buy those assets, right? They are not only regulated, they are very, very price efficient. They also don't have the purity and those risks along with it. They are very, very convenient to buy and sell. They are very, very liquid. I mean, liquidity, you have to uh, look at instruments differently because gold ETFs and gold saving funds are very, very liquid, whereas sovereign gold bond is not. So you have to pick and choose depending on what you want. So amongst the efficient forms, you have to see whether you want a gold backing to it or not, like physical gold backing. For example, gold ETFs and gold saving funds are physically gold backed, whereas sovereign gold bond is not physically backed. Secondly, on the returns perspective, sovereign gold bond gives you an added interest, but there is a lock-in involved in that. So you have to pick and choose what you want in terms of do you need a gold backing? Do you want liquidity? That all will determine how do you make that allocation. But don't go for physical, please. That's a very inefficient form of buying gold. Plus, it has all the hassles of purity and inconvenience. You have to choose from the efficient forms like gold ETFs, gold's saving funds, or sovereign gold bonds. You could go for any of these instruments.
Thanks, Chirag. Given that inflation is on the rise, will gold also prove to be as good an inflation hedge as equities?
So equities, if you see the initial bout of inflation, uh, is usually good for equities, but later on it starts impacting companies as well because companies have to incur a higher cost of their raw materials, and there is a limited extent to which they can pass it on without impacting their businesses, right? So equities in these kind of circumstances that we are seeing today, where demand is already weak or already been hit, in such kind of markets also, they will find it difficult to pass on price increases substantially to the end consumer. So in today's scenario, I think you should go with gold as opposed to equities, because gold will still kind of be a beneficiary, whereas equities could be a mixed bag.
Sure. Chirag, what are your predictions for the gold buying festival Akshaya Tritiya?
I think Akshaya Tritiya has been a significant, it's been the second largest gold buying day in India. So I think we will see a good amount of gold buying in that day as well. But I think somewhere there has been increased acceptance of products like gold ETFs and gold saving funds, and we're seeing a lot of interest in investors who are traditionally physical gold investors now moving on to these efficient investment vehicles. So I think interest will be high, and the current uncertainty will be, and the price increases that we are seeing will even improve the faith of investors in gold. And I think it's going to be a good buying day for the industry.
Sure. If you compare QGSR with its peer group, there is a difference. Why is that?
So if you see, there is something called over last 1 year, what has happened is uh, many of the funds have seen their size increase, right? We still saw a lot of buying from investors who are not earlier participants in gold markets. We have seen buying from even those kind of investors. So we have seen substantial flows in all the gold ETFs out there, right? And if you look at what has happened, this is a bit technical, but I will try to simplify as much as I can. What we have seen is as investors came in, or when the funds bought gold, they paid a portion of this gold as form of GST. This GST that they have paid on their gold purchases lies as a current asset in the scheme books. So in the statements that you see, or the fact sheets that you see, you will see a component called current assets, which will be a different proportion for different funds, right? This proportion uh, lies as current assets, and therefore the percentage of amount invested in pure gold uh, looks a little lesser than the 100% which you all were used to seeing since some time, right? Since many years. So, so this current assets is nothing but the GST credit lying in the fund's name, which will get realized when the fund sells gold. So you have paid GST. You'll only receive it back when you pay or when you sell the gold. So for different funds, this current assets is a different proportion. And for quantum, it was around, say, the gold invested was around 99%, and this current assets were around 1%. For other funds, it was a little lesser than 99% in terms of gold invested, and the GST component or current assets were a little higher. So what happens is when gold prices fall, gold proportion for quantum is higher, and therefore quantum falls more because it has more gold allocation at that time. And others will showcase a lower fall because their gold component is a little lower than what quantum has. Whereas if you see in a rising gold price environment, quantum will stand to benefit now because its gold proportion is higher than other funds, right? So uh, if you see the performance of the gold fund, quantum gold fund since last couple of weeks, when we have seen gold prices increase, we are seeing a better return from quantum as compared to other funds. Whereas when gold prices are falling, it showcased a lower return for quantum as compared to other funds. So this anomaly, which is nothing that they are doing or we are doing, but this bulge that we saw in the current asset is leading to distorted returns or a distorted relative return amongst funds. But quantum in a rising environment will be a beneficiary.
Thanks, Chirag.
I hope that I tried simplifying as much as I could, but it's kind of a little complex to understand.
Sure. Chirag, the next question is, while redeeming a gold ETF, can an investor get a gold bar or coins instead of money?
Yes, the simple answer to that is yes, you could get gold in return for your units, but there is a condition attached to it, right? Uh, what we buy and hold for on behalf of investors is 1 kg gold bars, right? Because why 1 kg gold bars? Because that is most liquid. That is the wholesale market in India. And therefore, we get a price efficient form of buying gold in 1 kg gold bars. And that is the price efficiency we pass it on to investors, making it more price efficient for investors, right? So if you have units equivalent to 1 kg gold bar, yes, you can surrender your units and take gold bar from places where we store gold. So today we store gold in 2 locations. One is in Bombay, Mumbai, and another is Ahmedabad. So there is a small process involved. All those interested, we can send you what is the process to be followed. But yes, you can surrender your units and take physical gold with you.
Thanks, Chirag. Chirag, is digital gold better than gold mutual fund?
So there are advantages for gold ETFs or gold funds over digital gold, very clear ones. First and foremost, gold ETFs, gold funds are regulated by SEBI, whereas for, if you see for digital gold, there is no regulator, right? It's each entity operating their own digital gold offering. There is no one regulator to ensure all the rules or framework in place. That is one important disadvantage for digital gold. Second, when you buy gold, you pay GST, right? Even when you buy digital gold, you pay GST, right? But when you sell your gold back, the GST that you paid, you don't get it back. So that's GST is 3% today. So that's a straight loss of 3% to you. When it comes to gold ETFs, gold ETFs are GST registered, and mutual funds being passed through vehicles. Uh, when we buy gold, we pay GST, but when we sell gold, we get the offset of the GST that we paid at the time of buying. So there is no loss per se for investors in terms of GST as compared to digital gold, where they lose out that GST credit. So these are the two very important differentiation where gold ETFs and gold funds have an edge over digital gold.
Thanks, Chirag. Chirag, is there a possibility for further import duty reduction in gold in the near future?
So it's very unpredictable, right? I would always advocate that the government should reduce the duty to zero, right? I think they will earn more by reducing the duty than keeping the duty at a high level, right? When duty is very high, there is illicit gold coming in the country, and therefore government misses on the revenue that they could earn on that illicit gold, right? So I will always advocate, but it is very unpredictable what the government will do, right? Sometimes they're concerned about their losing of revenue, because if they cut GST, they'll get lower revenue. But I think that's a very dubious argument. And I will always advocate, but that remains very unpredictable whether they will lower or not. But I think the path is very clear. They will try to reduce the import duty or custom duty over a period of time.
Chirag, can you throw some light on how gold mutual funds are taxed, and do they also have indexation benefits like debt funds?
Sure. Gold mutual funds are exactly taxed like a debt fund. So the taxation is like if you are holding gold units or not selling before 3 years, or you're selling before 3 years, then you have the short-term capital gains tax, which is as per your marginal tax rate. If you're selling after 3 years, then you get the indexation benefits like you get in a debt fund, which will mean that it is 20% with indexation benefits. And if you usually see the indexation benefit that you get, the tax rate after indexation comes to close to around somewhere between 8 to 10%.
All right, thanks. Chirag, what is the current gold component in the quantum multi-asset fund? Are you planning to increase or decrease the allocation of gold in the fund?
So our allocation is at 15% currently of the quantum multi-asset fund. We will maintain currently at this level until and unless we see a sharp correction in equity markets and therefore an avenue to increase allocation there. At that time, we may decrease a small portion of allocation in the gold fund, but until then, we will continue likely to maintain it at the 15% mark.
Sure. Between QGSF, Quantum Gold Savings Fund, and the multi-asset fund, which one should an investor go for? Because the multi-asset fund gives an exposure of 1/3 allocation to gold anyway. What would you recommend?
Yeah, sure. So it depends on how you have constructed your portfolio, right? If you have constructed your buying your own equity funds and your debt funds and gold funds separately, then you could look at having gold as a separate allocation through the QGSF. But if you're looking for a ready-made solution from the fund house, or if you're looking at multi-asset fund as a allocation of your emergency corpus beyond a certain amount, then it will be a small portion of your portfolio. So I think you could have both, depending on the context that you have in terms of your portfolio allocation. You could have, because you need to have gold to the extent of 10 to 15% in your portfolio. If you only have, say, quantum multi-asset fund as your allocation, then that's fine. Then you need not replicate as a QGSF allocation further. But if you don't have multi-asset fund as a main component of your portfolio, then you need to have an allocation through the QGSF to go or reach that 10 to 15% allocation level. So it will depend how you have constructed your portfolio. And if you don't have multi-asset fund as a core or a bigger allocation of your portfolio, then you need to have a separate allocation to see the bits and pieces and ensure that your gold allocation reaches at least 10 to 15% allocation level.
Sure. Chirag, how does Quantum store and audit their gold?
Sure, that's a very good question. I think uh, investors should be concerned about the gold and how it is held. So we store gold in professional vaults. So if you have seen Brinks, the vans moving around the country, you will have seen that same entity has professional vaults built. These are true vaults which have ironclad walls and all the safety and security measures in place, like armed guards, uh, uh, walls which kind of have panic buttons, movement sensors, those kind of things. So all kind of gadgets and security measures in place. Uh, plus, so these being secure, very secure places to store gold. Plus, all the gold that we have is completely insured, even for terrorism cover. So it is completely safe and secure in terms of gold that we have. Uh, so, uh, so this is how we kind of ensure, and it is our fiduciary duty to ensure that the gold is safe and secure at all times. Uh, Apart from this, we also do audits. In COVID times, it's been a little difficult for us to go to the vaults and carry out audits. But generally, in a general circumstances, we will ourselves go monthly to the vault. Apart from the audits that happen from the auditors, we ourselves will go to the vault to check each and every gold bar that we hold on behalf of investors. Second, we also do purity tests once a year to ensure that the gold that we hold on behalf of investors, apart from you having all the checks and balances in place in terms of the gold that we can accept in the fund, we do purity checks to ensure that gold is indeed gold for investors. So these are the kind of checks and balances we have in place in terms of security, in terms of ensuring purity, and in terms of audit.
Thanks, Chirag. What is the benefit of physical backing in an ETF versus no physical backing in a sovereign gold bond?
Sure, that's a very good question, actually. So gold as an asset is no one else's liability, right? So when you go to a sovereign gold bond, it is a liability of the government, and therefore, in some sense, you're changing the characteristics of being an asset to being an liability of someone else's. So that is a big differentiation, and many investors want that security of having physical gold in possession as compared to just being a guarantee of the government. So it depends on one's own comfort. It's not unlikely that the government is going to default. They can print as much money because they have that taxing power, and therefore the ability to print as much money as they want or issue as much debt as they want, and therefore you probably get all the money that you've invested. But here there are investors, or there is a philosophy that investors want a physical gold backing because it is at the end of the day an asset, and therefore that's the main differentiation of having a gold backing vis-a-vis having a guarantee.
Sure. Gold ETFs are taxed like equity, whereas gold savings fund are taxed like debt funds. So, can an investor get more returns by investing in a gold ETF?
No, I think that's a misnomer. That's not really true. Gold ETFs and gold saving funds are both taxed like a debt instrument. Gold ETFs are not taxed like equity. They are also taxed like a debt instrument. So, that's a clarification.
Thanks. The GST offset benefit that you spoke about, is that available or is that applicable in sovereign gold bonds as well?
Sovereign gold bond doesn't buy gold, so they don't pay GST, and therefore there is no offset there. So that's not a component that's applicable to a sovereign gold bond.
Sure. With that last question, we've come to the end of the Q&A. Thank you again, Chirag. To our investors, we hope today's webinar has highlighted that even though gold may have disappointed over the last few months, the case for holding the strategic asset in your portfolio is still very much intact. Though we have tried to cover as many questions as possible, if you still have any queries, please visit our website, www.quantumemc.com, and you can write to us or call our customer care and support team for further information. For those interested, the recording of this webinar will be posted on the official YouTube channel of Quantum Mutual Fund next week. Thank you all for tuning in. Good night.
Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.